Hello, good morning. Welcome to another ES Futures Trading stream. It has been a while since I did the last stream. I guess like about 2 weeks. I am focusing more in trading than any other thing right now. I've realized, I talk constantly that how this I cannot do two things at the time, and that's why I'm streaming less now. But if I see anything or if I don't see anything, I will just come here and start a stream. So if you want a notification, please just hit the bell, and you will have a notification each time the stream's live. What we have, the reason why I'm doing here is, we are coming from this B-shaped market here, like very weird situation that we have here. We have a break here that was it was a stealth break. I call that a stealth break, because the volume here was low, but was increasing, right? The increase was very subtle. It was going on. It was going higher, very subtle, until we have this non-linear break here that took care pretty much the whole contract. Since it started, it took even a little bit more, right? Since the September contract started, we are not that far, less than a month for the contract to expire, and now it's all back, right? It's 100% long again, right? And the curious thing, I hope you have noticed it, but I was monitoring this. I have this. This is the 200, 150, and there was a lot of buy. Not from the 200. I mean, it was very close to the 200. You can call it 200, right? But if I check Nasdaq was the leading. Well, was the leading indicator here. The Nasdaq is leading the market now, right? And it took the 200, and then boom. Then you got. I have used this. You can use this as well, right? But I don't trade basically on the indices. But I am not blind. I am not. I don't trade in a vacuum. I'm not oblivious to what's happening in other markets. And after that, this market it is just unbelievable what happened here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days. 12 days, The rally was getting old when it was coming close to the 200. I mean, close to the 50 here. Then it gapped through the 50, and it left only one gap up here. In the process, the market has left two gaps below. And when you were watching this, I hope you have realized, this impressive tail here. This is the excess in the monthly. This is really impressive. This is not all happen. Doesn't happen that often here. You could see, right? When the market opened, June high here, this was also, when the market was getting kind of like, the rally was getting old here. It may need a break to keep, if it wants to go, want to keep going higher. Now another situation that happened here, going higher, volume is each time low. Another time, another break, increasing volume. Volume increases a little bit, but look at this. What happened yesterday? Come on, man. Just look at that. Now, for today, the only thing I expect some volatility today. Now we have Jackson Hole at 4. my bad, at 10 a.m. But right now, no, the market is open right at 7. We have this break from yesterday that has gave us a 4-day range now. We have 1, 2, 3, 4-day range here. I will consider this the low of the range, and on this one the high of the range. Right, and something interesting here. We have these two distributions here. What the heck is this? Distribution close? Oh no, this is from this day. Oh, I am keeping this one because of this guy here. Notice where it, whether the, I will consider this. I will consider this volume rather. You know, this cluster here, cluster here, cluster here. You know, and right now, look at where the market is, right? Dead center. You know, market's opening, center is an advertising for chop. And I expect a lot of chop, a lot of volatility. My bad, and probably rotation as well. The break that we have yesterday, you know, there was only one thing that you could be yesterday. It was short. There was some rebalancing that you could expect in a day like yesterday. That, you know, the closer to the close, the better it was. But any longs here or here was super risky, you know, especially after, you know, after this market came back inside this range, didn't close this distribution. You missed the break here, you got another opportunity here. It's just unbelievable how the market can give you opportunities, but we have to be aware, right, what's happening. Yeah, you got something really nice here, you know, the out, you know, if this distribution close, that's an out. It's as simple as that. You know, different kind of day. One time frame ends here, one time frame ends here as well. Okay, so this is the directional move. The market has no conviction in the lower side. And add to this the volume. Right, the way how the market was trading, but it was a market to the downside, and you could see yesterday as well. You know, the laggard part of this day starts here, which happens to be. Well, this is not coincidence, right? It happens to be the overnight distributions, you know, right here. This is the laggard part of the break. Now they are out. Right? Notice this thing here, this thing here. And there's a lot of reason why this market can come back and check this area. What I am monitoring for today is one thing: these overnight distributions, and these ones here. But I don't expect right now. I have zero plans to do anything here. Now I want to go back to the bar chart. To the bar charts here. I had this when the market was going lower. This was a 5%. You know, 5% pullback. I had some here before. If you check, I don't know if I have this in the previous streams, but I have 6, 7, 8, you know, because I started in 7, you kind of like start to worry about, but the market never get close to 200. Instead, the mechanical, but there's a lot of algorithmic trade that happens here, you know, but algorithmic, many people misunderstand algorithmic, thinking that that the computers that are trading. Computers are placing the orders. My order is placed by a computer, right? But there is a human behind that builds the program, right? Buy here, buy there. And this was just so obvious here. Right? You had this 10% pullback here. From the all-time highs, you had a 10% pullback here. And look at where the market reached, right? You have a gap here. This is the 10%. This is a 10% rally from these lows, you know? 10% rally from these lows. 10% break, 10% rally. Can you see what's going on here? Right? So, but retail or small or short-term traders have no idea of this because most of us, I include myself in that group, right? Just do a trade and almost all the times we close before the day ends. We don't carry trades overnight, much less we keep a trade for 2 or for a couple of days. Most traders, most short-term traders do that. What is happening here, or what happened, was another kind of trades, another time frame going their thing here, right? And if we are going to have a new high, and if the market is going to make a new high, let's go back again to what happened yesterday. If the new high is going to be made, it's very unlikely that that movement towards the highs, to take the new highs, to take the highs, to make new ones, it's very unlikely that that movement is going to be conducted by short-term traders. That's not the job of short-term traders. And a bigger time frame participants are the ones that are going to start the push, right, towards this all-time high. And notice it's not really that much, that far from this. How many points? Like 40 points, something like that. It's really not that much. Something that has caught my attention as well, even though this huge rally, this bounce, rally, VIX has not dropped to below 15. Has not get to 14, 15. Which is an indication for me here that, but these participants are still perceiving this as a market with high risk. Another thing that kind of like favors that point of view is gold, right? Gold is perceived also as a hedge against, kind of like uncertainty, right? And gold's making new highs. This is what at a rally, a market rally that includes gold making new highs. Man, I will think twice, always. It made me think twice, right? But remember, that's kind of part of the broader picture, of the bigger picture. I don't do that kind of activity. I don't do that kind of trade. But it's something that I have to consider when I'm doing my trade. All right. Bonds, you can see bonds are trending higher. You can see this is what's happening. Crude, crude is kind of, there's uncertainty here in crude, and dollar is breaking. This break here, this break here, it's trending lower here. I want to see, this could be something that the market may start to pay attention here. Let's check this thing out. Right? What I have here, this is not 2023 low. It has taken the year. Look at this. This is 2024 lows. This is very. I think there must be might be something here. 2024 low here. Of course, this is the low now, but it was this before. Then we have the next thing, which is not that far actually, would be these two things here. this kind of markets or have a tendency to have some impact in the market when there are extremes, right? Either they're up here or down here. Well, it's getting closer to this. Okay, I will keep an eye. I will keep an eye on this market here. Now our market, the ES, one time frame has ended. It didn't reach the opposite side of this range in the monthly. Weekly is trending higher, and of course, the daily was trending higher as well. Now, one time frame has ended. Let's see, we have some sideways trading here. Right, so far, 4-day range here. And another thing that I was checking here also was this range here. This is 4 or 5-day range that I have here. And the same kind of action or dynamics the market has it here in the monthly, for example. This is the closest example that comparative example that I can have, right? This happens all the time, right? It happens more in the daily, right? But it didn't check the opposite side of the range. Now the same thing can happen here. Can you check the upper side of this range after this impressive movement? Right, it's not that far, right? It shouldn't be that hard to reach this, right? But I am checking this range now. I am going to put here. If I use this as a reference here, this would be, I guess it's 50. What is this low? 56.90, 56.30, 56.31, 56.30. Call it 56.30. All right, this level here. No, simple things here. Simple things. Is the market? Is the market? I don't have this level and then see the market. Right? The market should bounce from this. I don't do this. It's the other way around. Is the market paying attention to these levels that what gives validity to the level, to such levels. Well, I can see that. I can see that that's what's happening now. It is stopped here first. It trades back and forth, back and forth, back and forth. Now let's see if there is some selling. Can you see where the market is at right now? This is what it's so important to do your homework every day after the market close. Do this. This is really simple. It's not that complicated, but it's really hard to do. Having the job, right? Having homework, something scheduled to do every day after the market close. To keep an eye on this. Right? It is better when you write, because it can stick to your mind for longer. Right? After I check this, let's see where that level is in my TPO charts. 34, 31, it was 30, right? This area here. What do we have here? I have this distribution here. So it becomes, this distribution then becomes more relevant now, right? This rally that failed to close this. But notice another thing. Another thing is that this distribution closes the action here, right? It's very close, very close to POC here. It is POC, all right? Being this close, I can call it is POC. It's a mechanical reference, what I can see there. The mechanical way how the market is trading is not a particular thing from yesterday. It has been that, since like 1 year, 2 years, very mechanical, very mechanical. And so that hasn't changed, right? So I could say that business as usual, right? But not what changes, what happened yesterday, the way how this market break was just unbelievable, right? It's unbelievable. I could see just really short-term trading going on yesterday. Not big money or big capital involved. Probably just a hedge at the volume. Volume also was very questionable, as we talked earlier. Now, today, the first thing that has changed today, notice this, the first thing that is changing is volume. Yesterday, we have one of the lowest volumes. Now, a little bit higher than previous days, right? Not significant. Now, notice where these ones are, the previous 10, they are higher. But that's one piece of information that has changed, that is changing relative to yesterday. Now, check your clocks, check your watches. What time is it now? We are almost 10. Chairman Powell is set to speak now, and we have lower volume than yesterday. Okay, let me check if I can find Chairman Powell's speech.
It's a super important topic, particularly right now.
Yeah, I guess you can.
And we've got some great papers lined up for this morning. We've got 2 papers, and
I'll find one at Benzinga. And Benzinga, I guess Wall Street Journal also has one. Scheduled events, new home sales, nothing. This is just, what's happening now, the spike we are having now in the market. This is just, look at this, man. This is what is happening now. What you are seeing now is short covering. The way how this market moves. That's short covering. Now, that saddle is incorrect. Let me check it, what it is. 55.94. We have 55.94. 55.94. 55. What? Way down here. Overnight inventory is 100% long. This is yesterday's set. Did you see where it stopped? Come on, man. It stopped right at yesterday's saddle. I mean, not yesterday, but Wednesday. This is not more. This is short covering, my friends. Whatever we're witnessing here, it is short covering. Now, all the activity from yesterday, is happening now. Look at this, man. Check it out, man. gosh, man. Look how it dries and boom. What do we have here? Nothing. Okay, let's see. These distributions both are being closed now. I will keep only this one, but not as a distribution close, but I will call it maybe support resistant. This one has been closed. Oh, Chairman Powell is speaking now.
Inflation low and stable, healthy real wage gains that were increasingly concentrated among those with lower incomes.
Let's hear what Chairman
Today,
Powell has to
the
say.
labor the unemployment rate began to rise over a year ago and is now at 4.3%. Still low by historical standards, but almost a full percentage point above its level in early 2023. Most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen, and the ratio of vacancies to unemployment has returned to its pre-pandemic range. The hiring and quits rates are now below the levels that prevailed in 2018 and 19. Nominal wage gains have moderated, and all told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions. So let's now turn to the questions of why inflation rose and why it has fallen so significantly even as unemployment has remained low. There's a growing body of research on these questions, including Gowdy Eggerson's work, which we'll shortly discuss. And this is a good time for this discussion. It is, of course, too soon to make definitive assessments. This period will be analyzed and debated long after we are all gone. The arrival of the COVID-19 pandemic led quickly to shutdowns in economies around the world. It was a time of radical uncertainty and severe downside risks. As so often happens in times of crisis, Americans adapted and innovated. Governments responded with extraordinary force, especially in the United States. Congress unanimously passed the CARES Act. At the Fed, we used our powers to an unprecedented extent to stabilize the financial system and help stave off.
Check where the buying is coming from, right? Distribution
After
will
a
be closed.
historically deep but brief recession,
We have one time frame
in
higher, but the
mid-2020,
buying is
the
coming
economy
from
began
high
to
back.
grow again.
Exactly coming.
And as
It
the
was a
risks of
pullback
a severe extended downturn
and
receded,
buying
and as the
or
economy
selling disappeared
reopened,
here.
we
buying
faced the risk
came
of
back over here.
replaying the painfully
Just
slow
keep watching
recovery
this.
that
I am,
followed the
I am
global
watching
financial
this.
crisis.
Why I'm listening to Chairman Powell.
Congress delivered substantial additional fiscal support in late 2020 and again in early 2021. Spending recovered strongly in the first half of 2021, and the ongoing pandemic shaped the pattern of the recovery. Lingering concerns over COVID weighed on spending on in-person services, but pent-up demand, stimulative policies, pandemic changes in work and leisure practices, and the additional savings associated with constrained services spending all contributed to a historic surge in consumer spending on goods. The pandemic also wreaked havoc on supply conditions. 8 million people left the workforce at its onset, and the size of the labor force was still 4 million below its pre-pandemic level in early 2021. The labor force would not return to its pre-pandemic trend until mid-2023. Supply chains were snarled by a combination of lost workers, disrupted international trade linkages, and tectonic shifts in the composition and level of demand. Clearly, this was nothing like the slow recovery after the global financial crisis. Enter inflation. After running below target through 2020, inflation spiked in March and April 2021. The initial burst of inflation was concentrated rather than broad-based, with extremely large price increases for goods in short supply, such as motor vehicles. My colleagues and I judged at the outset that these pandemic-related factors would not be persistent, and thus that the sudden rise in inflation was likely to pass through fairly quickly without the need for a monetary policy response. In short, that the inflation would be transitory. Standard thinking has long been that as long as inflation expectations remain well anchored, it can be appropriate for central banks to look through a temporary rise in inflation. The good ship transitory was a crowded one, with most mainstream analysts and advanced economy central bankers on board. I think I see some former shipmates out there today. The common expectation was that supply conditions would improve reasonably quickly, that the rapid recovery in demand would run its course, and that demand would rotate back from goods to services, bringing inflation down. For a time, the data were consistent with the transitory hypothesis. Monthly readings for core inflation declined every month from April through September 2021, although progress came slower than expected. The case began to weaken around mid-year, as was reflected in our communications. And beginning in October, the data turned hard against the transitory hypothesis. Inflation rose and broadened out from goods to services, and it became clear that high inflation was not transitory and that it would require a strong response if inflation expectations were to remain well anchored. We recognized that and pivoted beginning in November. Financial conditions began to tighten, and after phasing out our asset purchases, we lifted off in March of 2022. By early 2022, headline inflation exceeded 6%.
So what is happening now?
Above 5%.
So what is Chairman Powell saying that can have an impact in the market the way he's having it now? Nothing. He is saying nothing, right? Nothing that we don't know. He's just recapping what
in part due to further COVID
basically
in the United
basically
States.
he's recapping what
to
happened.
disrupt production globally, including through
Nothing
new
that we don't
and
know
extended lockdowns in China.
already.
Higher rates of inflation
Right.
are a global phenomenon reflecting common experiences: rapid increases in the demand for goods, strained supply chains, tight labor markets, and sharp hikes in commodity prices. The global nature of inflation was unlike any period since the 1970s.
And what I'm considering this short COVID. This is short COVID. Oh, this ridiculous break that we have yesterday. This is short COVID. This is the culmination of the short COVID that I started right after the market closed yesterday. Rather, either regarding if this is going to have upside extension, if we're going to take the yesterday's high, that's another story, right? This high, this was rotation as well. No, the trade from yesterday is over, right? The market didn't pay attention to the overnight long inventory. Inventory. There's a lot of long inventory that's in weak hands now. Okay, let's keep listening.
Growth. Some argue that getting inflation under control would require a recession and a lengthy high unemployment. And I expressed our unconditional commitment to fully restoring price stability and to keeping at it until the job is done. The FOMC did not flinch from carrying out our responsibilities, and our actions forcefully demonstrated our commitment to restoring price stability. We raised our policy rate by 425 basis points in 2022 and another 100 basis points in 2023. And we've held our policy rate at its current restrictive level since July 2023. The summer of 2022 proved to be the peak of inflation. The 4.5 percentage point decline in inflation from its peak 2 years ago has occurred in a context of low unemployment, a welcome and historically unusual result. So, how did inflation fall without a sharp rise in unemployment above its estimated natural rate? Pandemic-related distortions to supply and demand, as well as severe shocks to energy and commodity markets, were important drivers of high inflation, and their reversal has been a key part of the story of its decline. The unwinding of these factors took much longer than expected, but ultimately played a large role in the subsequent disinflation. Our restrictive monetary policy contributed to a moderation in aggregate demand, which combined with improvements in aggregate supply to reduce inflationary pressures, while allowing growth to continue at a healthy pace. As labor demand also moderated, the historically high level of vacancies relative to unemployment has normalized primarily through a decline in vacancies, without sizable and disruptive layoffs, bringing the labor market to a state where it is no longer a source of inflationary pressures. A word on the critical importance of inflation expectations. Standard economic models have long reflected the view that inflation will return to its objective when product and labor markets are balanced without the need for economic slack, so long as inflation expectations are anchored at our objective. That's what the model said. But the stability of longer-run inflation expectations since the 2000s had not been tested by a persistent burst of high inflation. It was far from assured that the inflation anchor would hold. Concerns over de-anchoring contributed to the view that disinflation would require slack in the economy and specifically in the labor market. An important takeaway from recent experience is that anchored inflation expectations, reinforced by vigorous central bank actions, can facilitate disinflation without the need for slack. This narrative attributes much of the increase in inflation to an extraordinary collision between overheated and temporarily distorted demand and constrained supply. While researchers differ in their approaches and to some extent in their conclusions, a consensus seems to be emerging, which I see as attributing most of the rise in inflation to this collision. All told, the healing from pandemic distortions, our efforts to moderate aggregate demand, and the anchoring of expectations have worked together to put inflation on what increasingly appears to be a sustainable path to our 2% objective. Disinflation while preserving labor market strength is only possible with anchored inflation expectations, which reflect the public's confidence that the central bank will bring about 2% inflation over time. That confidence has been built over decades and reinforced by our actions. That is my assessment of events. Your mileage may differ. So let me wrap up by emphasizing that the pandemic economy has proved to be unlike any other, and that there remains much to be learned from this extraordinary period. Our statement on longer-run goals and monetary policy strategy emphasizes our commitment to reviewing our principles and making appropriate adjustments through a thorough public review every 5 years. As we begin this process later this year, we will be open to criticism and new ideas while preserving the strengths of our framework. The limits of our knowledge, so clearly evident during the pandemic, demand humility and a questioning spirit focused on learning lessons from the past and applying them flexibly to our current challenges. Thank you.
So that was it. I didn't hear anything here that is worth to, the movement we are witnessing now. This is short covering, my friends. Just short covering here, relative to yesterday's. And the market could not. The market could not take yesterday's high. Look at that. All of this. Who's holding this? All of these guys are holding this. Overnight traders are not particularly well known to be the strongest ones. Now this is the second time the market is coming to half back.
Powell's done already?
Wow. Okay. So what's the market doing now?
Selling off.
Just like I thought.
All right, guys. Yeah. Why the? I guess we can have something here. Right and back again. Right at yesterday's settle. It came back to settle. It stopped and settle in the way up. It's stopping and settle in its way down. There's a lot of activity right now at this area. I might feel tempted to do something here. Still, I will use. Let me take this one out. And let me close this. I will use this guy here. I will put this one over here. I want to see the volume here. Oh, check it out. Check it out. All the activity I don't have back. Well, this time is different because what I see is there's a bunch of profit taking here. Also, this is quite relevant here, right? This significant blocks here in the way up. Half of the volume that happened at this level, at the 60, more than half was my bad. No, 1/4. Right. This was only one transaction there. Only one transaction. Did the market come back to this? This is the distribution close. It's at 34 support resistance area. No, it is inside. Remember remember this. It's inside this range here right now. That's why I'm having this around the 40-30, something like that, as a support. This is very important to me. Right? This will mean acceptance. Inside is a rejection of the penetration here. In the same way as we have rejection of the penetration, not a rejection, it was accepted, but it didn't reach the opposite side. Now we have another range here, this time in the daily time frame, right? Market's trying to dig deep into this one and take, another part of this gap with not closing it. Uh-oh. What's happening? I can't hear it. Oh.
far does it need to go in terms of getting the policy to the right place? That's going to be the debate inside about exact. This discussion, it's probably part of the next discussion.
Steve, people are looking back to the speech 2 years ago, and Sarah mentioned this briefly, where he said that the move, the working until the job is done, would bring, quote, some pain to households and businesses. What do you think his characterization of the pain that we did sustain would be?
I'm glad you brought that up, Carl, because I had that pull quote. Guys, I don't know if you can bring that full screen up. He said, with an appropriate dialing back of policy restraint, there's good reason to think the economy will get back to 2% while maintaining a strong labor market. So effectively, he's backing off that pain prediction. And he's kind of, that's the kind of saying, hey, I think we can do this soft landing thing. We didn't really have to have as much of the pain other than, of course, the inflation pain that he talks about, but did not have to have the joblessness. And so now he's saying, you know, we do not welcome further weakening in the job market, so we can cut it off here, make that adjustment, and maybe get out of it. You know, how does the Fed do this soft landing? Well, it's tried a couple times. It's maybe made it once, and not all that often has it succeeded. So this will be pretty historic if they pull it off. And he's kind of telling you, I think we can do that if we adjust policy now.
One other reason for the market move, and Neil Dudd is just pointing this out from Renaissance Macro, Steve, is he did not use the word gradual, unlike some of the other speakers that we've heard on the Fed. In other words, he's not taking off the possibility or the option of doing a larger move if they feel like they have.
Oh boy. I apologize for the noise that you were hearing. I just realized I wasn't using my microphone. So probably you will have you will hear some echo as well. Really bad stream today. And that high, you know, yesterday's high, today's high is 10%. Let's check some. What? This high is not good. This high is not good. High, not good. Look at this. This has a this make my can lower here. Oh, look at this, man. Netflix and Meta making new highs. It's trending lower. So range going lower. It has room to the upside. This one too, this one too, this one doesn't. Oh yeah? Okay. It was profit taken here. I didn't like this huge. I exactly at the 60 here. I don't have anything right now. What the heck is this 55.50? No idea what the heck it is. All right, guys. Unless you have any questions, I will be calling it a day. And wish you a good rest of the day. Stay safe. I hope I can see you tomorrow. I won't see you tomorrow. Tomorrow is Saturday. Market's closed. Hope I can see you. Have a wonderful weekend. I hope I can see you next week. See you. Bye-bye.